We only have 45 minutes of content and then 15 minutes of questions at the end. So we'll dive right on in. Thank you guys all for joining us. Really excited for our mastermind panel, the first of its kind. We have three esteemed guests joining us: Dave Durell, Andrew Gray, and John Eichmann. As you guys can see, they're all spotlighted on your screen. We'll kick things off with Dave. So he has a really unique background. He got his undergraduate and master's in criminal justice, served as a law enforcement officer in Wyoming, Michigan for several years, working his way through grad school and then law school at Western Michigan, where he graduated cum laude. Dave is one of the most gritty, hardworking, but also empathetic people you'll ever meet. Extremely impressive individual, has had a very illustrious career as a corporate attorney, representing clients in a wide variety of real estate transactions, and most especially hospitality transactions. As of currently, Dave is of counsel at Dickinson Wright and focuses on commercial real estate, M&A, and the investment process as a whole. Has counseled and represented clients across a broad range, however. And before Dickinson Wright, Dave did found Durell Law and served as chief investment officer for a private equity firm that specializes in REIT investments, UPREIT transactions, and asset management. So we're happy to have him with us today to help shed light on a highly relevant topic for real estate and hospitality right now, which is insurance, and of course, all the implications that can have on the balance sheet and overall risk of the business. So Dave, thanks for joining us. Thank you for your time. And please feel free to add in anything that I may have missed.
Oh, well, thanks so much for the wonderful introduction, Becca, and thanks for having me today. I'm pleased to be here and looking forward to a great discussion today. I think you hit all the highlights on my career. You know, I've been transacting hotels as a primary activity in my legal practice since about 2008 or 9. I did serve in-house counsel at a private equity firm specializing in hotel investments in both real estate investment trusts and opportunity zone investments. And I think you touched all the rest of the bases there. So thanks so much for that.
Yeah, my pleasure. We'll circle back to you in a second after I introduce the rest of our panelists. And forgive me, guys, I forgot to introduce myself. So my name's Becca Fowler. I'm the Vice President of Hospitality at Virtus Insurance on the Kemmons Wilson Hospitality Team, and we specialize in hotels and resorts. We're a vertically oriented firm, and I will be moderating the panel today, hosting our three esteemed guests. So moving on to our next one, we have John Eichmann, Managing Partner at Virtus Insurance, and hands down the smartest person I know when it comes to employee benefits. It's not an exaggeration to call him a genius. After almost 30 years in the industry, John's worked with thousands of clients now to impact their business positively, but also, probably more impressively, hundreds of thousands of employees at this point. So no one understands the benefits marketplace better than John. We're very fortunate to be joined by an industry savant. He has unmatched relationships in the marketplace and really an intense desire, guys, to consume information constantly and know absolutely everything he can to advise our clients. And because of this, it really does give him the insights to see things around the corner that haven't even happened yet and advise clients accordingly. So John, obviously I've called you Nostradamus before because of this. We could not be more excited to listen to some of your predictions and forecasts later in the hour. But in terms of background and introductions, do you have anything else to add?
Well, it's hard to top Nostradamus, savant, and genius, so I think I can stop with that. No, actually, Becca, thank you very much for inviting me. I have been in the health insurance business, both on the carrier side, in underwriting, worked with IT, building rating models and actuaries, and then, of course, on the consultant side. And I just love consuming information about my craft, what I do. This is my sport, and I actually have been doing it 36 years now. And
wow.
I used to say I've seen it all, and then we had the first pandemic in 100 years. Now I've seen it all. So anyway, thank you. Thanks for inviting me, man.
Absolutely. Let's hope 2023 doesn't bring any more once in a century surprises for us. But who knows what could be around the corner. Okay, last but not least, our third panelist, Andrew Gray, founder and CEO of Virtus. We have an industry pioneer joining us today, another absolute genius, insurance guru, and industry savant. And I say that not only because he's my boss, but also because it's true. Very hands-on, still rolls up his sleeves and looks at policies in detail today. So really excited to hear from him. I've never seen someone structure programs so creatively for clients or really be able to pull out as many hidden flags as this guy. So we are extremely lucky to be joined by somebody that has been pioneering a really different type of consulting firm. So Andrew, to round out your introduction and set the stage for your contributions for the rest of our conversation, I know our audience would love to hear, as Virtus turns 10 this year, and thinking back to the founding of the firm and the business and really just getting fed up and saying, hey, we need to go out on our own and do this a different way, and pioneering an experience-driven, vertically oriented, specialized firm. Tell us about kind of what got you to that point and what you're most excited about as Virtus turns 10.
Absolutely. And thank you for the kind words, and thanks for putting this panel together. Very excited to be here. But I think you hit on it in your kind of summary there. We just saw a better opportunity in a better way as we've studied the insurance marketplace, both on the property casualty and the benefits, and really just understood risk and kind of the evolving risks that the macro market faces, but specific to this conversation, the hospitality sector faces. We thought there was a better way to consult and broker insurance product, which is what we do. And I think a lot of that fundamentally comes down to educating our clients, empowering them with the information to make really good decisions about what they're doing. And so it takes a unique firm, different from our peers that John was talking about just a second ago, where we consume tremendous amounts of information and data and form opinions on these things, and then are able to articulate those opinions in a meaningful way to managers and operators that help them ultimately make better decisions for their business and focus their attention on achieving and accomplishing their objectives, while mitigating the risk to operating the business at the same time.
Absolutely. Well, hotels are fun, right? But they are businesses, and our operators are mostly concerned first and foremost with not only providing an exceptional experience, giving back, corporate stewardship, all of that, but driving a profit and being able to keep the lights on. So insurance right now, with the market being so hardened, is just such a topic that everyone's coming up to conferences and asking me about, emailing questions in. And so I'm going to kick our first one out to Dave, since he has done dozens of transactions. And I mean, this guy, he even has trademarks and patents and all sorts of different things that he has worked through. But Dave, if you could talk about the 2 to 3 most concerning things you're seeing in the market right now for insurance as it relates to your clients, some of the biggest mistakes they're making with these transactions, and what advice would you give them to be able to better navigate the environment that we're in right now?
Yeah, sure thing. Thanks for that, Becca. I think my biggest concern for hospitality clients and clients in general as it relates to insurance can be summarized by saying, I worry that they don't adequately use their insurance advisors, and they don't adequately undertake the review of the types of insurance and indemnity obligations that they're undertaking when they enter into transactional contracts, whether it's the buy-sell with the other party, the franchise agreement, the construction contracts to complete their PIPs, on and on. As we navigate transactions, all of these contracts have indemnity provisions that delineate who's responsible for what, who's going to pay when there's a claim, if there's a claim, who bears the risk of loss if the hotel is damaged or destroyed during the term of the contract before ownership changes, what the liability is after the transaction post-closing for things like construction defects, misrepresentations of warranties, omissions. All of these aspects are insurance risks. And so I see a lot of folks that just tend initially to be content with accepting the language that's in the contract, having their lawyers look at it, and then signing away. But I always encourage clients to really send those provisions to their insurance advisors, put me in touch with their insurance folks, let us talk to them about the wisdom of accepting those risks, make sure they truly understand what risks they're accepting and what coverages they have in place when those things occur. It's been a number of years ago, but I worked with a client that suffered a significant loss related to data breach and credit cards. And you think through the number of credit cards that hoteliers are processing in one way, shape, or form throughout their operations. And then there's contracts between the franchise, the online travel agencies or OTAs, the banking systems, the credit card processors, and you wind up wondering who's left holding the bag if there's a data breach. And so as we talk about the different ways that we can protect clients, I think that's a topic that really is top of mind for me.
Thank you for that. I'd love to, and just kind of going off of that, would love to hear more about why involving the advisors early is so critical. A lot of times what we'll see and hear is, oh, my broker got me the quote 4 days before the renewal, and I didn't have time to even look at the provisions and make sure that I was covered correctly, not even to mention pricing.
Yeah, for sure. Those contracts, generally speaking, are negotiated for a number of days or weeks in advance of the closing, and to have insurance as an afterthought is truly a area for improvement in most transactions. There's nothing that prevents the hotelier or their legal counsel to reach out to insurance advisors the moment they get the contract, the first draft of those provisions in it. And I think that the folks that navigate the underwriting and the insurance components and provide advice to clients about where they should have insurance and understand the indemnity and risks alongside the lawyers are best suited to help with that advice. And to your point on pricing, most of my clients navigate transactions with some kind of financial underwriting model, and to have sticker shock at an insurance policy late in the game when you're outside due diligence timelines or other such things is really a financial piece that could also be, a strong area for improvement in many hotel transactions, in my experience.
Yeah, and sticking on the topic of transactions, Andrew, you've been involved in hundreds of them at this point. As on the insurance side of things, what are some of the biggest mistakes you're seeing when you first get eyes on them?
Yeah, I just largely piggyback off of what Dave was talking about there. I think integrating the team in the diligence of the transaction, whether it's, the legal team, compliance team, us in insurance as well, is super critical around the transaction, because, as Dave was pointing out, the transaction, the contractual documents will specify indemnity and who's responsible for what. And in most scenarios, if we know, we can align the insurance to respond accordingly. And that goes with transactions as well as just in the operating business. If you look at the forward-looking or continued operations of a business, the vendor contracts, supplier contracts, what are the responsibilities, indemnification provisions in those contracts, and does their insurance adequately respond to them? And the hotel or the management company, does their insurance respond? Management contracts, how does that read between the owner and management group, and who's responsible for what, and how the insurance responds there, and the franchise agreements as well. So again, I think trying to coordinate in a perfect world, the advisors, legal and insurance in this case, is super critical, because, we can add a lot of value collectively, and we can add even more value if we've got, eyes open and transparency around the contractual risk that we're talking about here, as well as just other economic factors.
So hotels are unique in the sense that there are all these different entities, SPEs, and named insured is such a big topic on making sure that is done appropriately. Talk to me a little bit about that and some of the mistakes you've seen and just some things that our hoteliers should be aware of and asking their insurance advisors about, maybe even checking their own policies today.
Yeah, I mean, I think it's important to note that these insurance contracts are that they're contracts, and for a premium, a dollar amount paid in, the provisions within the insurance contract will respond given a certain fact set. And so there are very simple things that can cause big issues, right? Having the appropriate naming conventions of the named insured is what you're referencing right here, so that if there's typically a ownership group that might only own the real estate, and then a management group, whether those companies are interconnected or not, we typically see, an insured say, well, it's the same people. Well, legally, it's not the same. And so it's a very simple fix to an insurance program. We see it all the time, in which we've got to make sure all of the entities that are supposed to be insured actually are insured, because it's a very easy way for a carrier to deny a claim if an entity is not appropriately listed on the policy. And I think that's just like an inch deep as it pertains to the contractual provisions. I mean,
Yeah.
I know from long-term experience, a lot of consumers of insurance or buyers of insurance focus extensively and almost exclusively on the price component, the premium component, which no doubt is an important factor, even more so today given the environment. But the provisions within that policy that can exclude coverage for things like assault and battery, can exclude things for coverage like carbon monoxide. These are, eight-figure type claims that we see day in, day out, may cost a simple, few $100s extra to get insured. And if you don't ask the question, or you're not even looking at the appropriate documentation, or have an advisor that's guiding you there, you could be in a really difficult spot as an operator or a management company.
Yeah. Dave, do you want to jump in there? Because it just made me think of all the many ways that this could get back to the attorneys if, to Andrew's point, that's not buttoned up appropriately.
Yeah, sure. I think Andrew makes a great point that insurance touches every aspect of the industry, whether it's your liquor liability from your F&B components, whether it's your general liability for things like slip and falls, whether there's liability, premise liability related to criminal acts on the premises, the data breaches. All those things are things that can be insured against. And like everything that business owners navigate in their decisions to make business decisions, they should consider what level of risk tolerance or risk aversion they have there, and they should make those decisions being well informed by their insurance advisor about what the cost of the coverages are, what the coverages would take care of. Also understanding, frankly, the subrogation provisions and what the insurance company will need in the event of a claim. What's your notice timelines? What information are you required to preserve and provide in the event of a claim? And just being prepared for those things that happen. I mean, the last thing you want to do is get caught flat-footed on having an event at your property and then trying to figure out whether you have coverage and how you're supposed to navigate implementing those claims at that time. Those are things that we should be prepared for in advance of the events.
Absolutely. And before we get too far down the rabbit hole, because there's so many different directions we need to go in the next 25 minutes, I want to pass things over to John and just tie a bow on this transactions piece. Speaking of benefits not being an or insurance not being an afterthought, employee benefits. I mean, employees expect benefits these days. Tell us about what that looks like during the transaction process, how you get involved from a diligence perspective as it relates to the insurance, and some of the mistakes you're seeing and ways that advisors can really be instrumental in that process.
Yeah, no, I appreciate that. So the benefit side, in particular health insurance, is important to look at during the transaction, prior to the transaction. On the P&C side of the house, it's a lot of, here's what you have, here's what's going to change and close, here's what you need to kind of like button up before the transaction or as the transaction plays out. On the benefit side, it's here's what you have and here's your opportunity post-close. A lot of times we get involved, in particular in like an add-on situation, and we just the transaction is I've got a large entity over here that's buying a smaller one over here, and we're just going to roll the health insurance into the corporate plan, if you will. And that might not be the best decision. We'll take a look at claims data that's available. We even have sort of a backdoor way to get claims information, or at least identify if a large claim exists in that acquired population. And it might make sense to keep them separate. If I have, a corporate plan that is self-funded, and I've got this small little plan over here that's currently fully insured, and it has a large claim in it, maybe we want to leave that large claim with the insurance company and let them take the risk on that. And so there is a lot to look at. And again, it's mostly, here's where we are today, but here's our opportunity post-close. Maybe we merge them together, maybe we don't. So it's all in the data for sure.
Yeah. And I know I'm kind of putting you on the spot here, but is there any, can you think of any examples of those opportunities post-close that you've helped clients with? And I know you've mentioned dozens of them to me before, but maybe just a few that people wouldn't originally think about that might surprise some of our hoteliers on the call.
Well, yeah, that's not a problem at all. We actually, Andrew Gray and I were just at a prospect of ours a couple of weeks ago, and they have a large corporate plan, and they bought two smaller entities, one in Oregon and one in Vermont. And they've been advised you cannot put these together. It's just impossible to do that. And so we're looking at that going, no, it's possible. It might not be the smart thing to do. And so in this particular case, both of these groups are small enough where there isn't claims data readily available from the carrier. They just don't have to disclose it, so therefore they don't. However, there's rating systems out there that these carriers use. One of them is called GRX. And so we can run a census of people through that, and that system will tell us, it doesn't identify them, but it'll tell us, hey, we see X prescription being filled, which means their claims are likely going to be hundreds of thousands of dollars. Or we'll see that system kick out a very, very attractive rate. Well, we know right now that that particular group is clean, if you will, from a claim standpoint. Mm-hmm. And so that's those types of tricks, if you will, that good advisors know how to handle. Other advisors, like the one that is currently advising this client, is basically you'll never be able to know what's in that group, so therefore never merge them together.
Yeah,
just got to dig a little deeper, I think.
That makes sense, and also highlights why it can be so critical to have advisors that specifically understand the asset class that you're working in, like hotels and resorts and other leisure properties, for example, and restaurants. Kicking things back over to Dave. This is kind of broad, so go with it where you would like. But as it pertains to you advising your hotel clients, talk to us about what you're most focused on right now that you think they need your help with these transactions. And then just in general, headwinds and tailwinds that you're seeing in the industry.
Yeah, sure. Maybe I'll start with the second part of that question at the outset and say, I think that on the headwinds, we're finding unique transactional opportunities and structures that clients need to get their deals done these days, with the market hardening a little bit, cost of construction being a little unpredictable, the lending institutions having some uncertainty in interest rates and underwriting and things of that nature. I think we're starting to see things like private equity and capital stacks with waterfalls take over the lending piece on hotel transactions, which creates a unique set of frankly insurance matters, because now you've got a whole new set of stakeholders that you have to worry about, with things like your E&O policies and your those types of professional liability insurance, and how you protect those folks from liability on things like your liquor liability and other things of that nature, right? And all those again tie back to the insurance contract provisions we talked about.
Yeah.
On the tailwinds, things that are pushing the industry in a good direction, I think travel's greatly back. We're seeing the industry greatly stabilizing with performance. I think one of the common themes at the couple industry conferences I've attended this year is that for many hoteliers are seeing year-end 2022 performance was exceeding year-end of 2019. 2019 was a benchmark that we've used on my side of things for a long time as the recovery benchmark, right? How are you recovering through COVID against your 2019 year-end performance? And to hear that lots of folks are saying that they exceeded it in 2022 is tremendous. To touch on John's points about employees and employee benefits, I think that most hotels, maybe as high as close to 80%, are seeing understaffing issues. That was also an additional key point at some industry conferences this year. As much as in the 20% range are seeing significantly understaffing issues at their hotels. The good news is that's an improvement over a year ago, April, when 96% of hotels were seemingly reporting issues with staffing, and 63% being severely understaffed. And so to tie all that together, what I'm most focused on right now is really, as always, trying to navigate the current industry challenges and opportunities, recognizing that every challenge brings a unique opportunity for improvement, and just working with clients to help them continue to transact in these unique times. And we've seen, to John's point, outside of the only pandemic in the last 100 years, we've seen a lot of the economic conditions that exist today in the not so recent, not so distant past. And so to navigate those things through creative acquisition structures, creative joint ventures, creative partnerships, and creative strategic alliances is really the most fun part of my job. And so that's really where my main focus is today, is just hearing from my clients and customers what it is that they're seeking to achieve, and helping them find structures to accomplish those achievements.
And we appreciate that input, Dave. And that's a perfect segue to my next question, which is, with the hardening, I'm going to toss this one out to Andrew. With the hardening of the market, Dave's point is it should be so well taken about the importance of creative structuring, and it's so much more than just getting a quote, diving into the contractual provisions. The devil is in the details, so to speak. So one of the things we're all seeing is a rise of these shared limits programs and RPGs. So talk to us about some of the creative structures you're seeing, what they are, and just different ways to get creative in this hardened market, and why some of those programs may or may not make sense for our hotels.
Yeah, great. And let me paint a little bit of a picture first of what's kind of caused some of the stress or hardening of the market. So, you've seen kind of record storms, whether it's fires in California or hurricane damage in Florida, and then the convective storm stuff here in the Midwest where we're located, as far as hail and wind damage. And so you've seen an underwriting performance that's performed very poorly. Compound that over the last 5 years with what has happened from an inflationary perspective. So you've got, a really tough time period here, the last couple years with inflation of raw materials. And now because of labor shortage, you've got, increased cost of construction in addition to the materials. So, paint that picture real quick, that to replace a building that burns down or has hail damage or, is flooded is more expensive than it was 3 years ago. So you've got, just what I'll call inflationary pressure on the property side, pushing up claims costs and subsequently pushing up insurance premiums. And, the other side of the equation, liability, workers' compensation, you've got a continued increased what we call social inflation environment, which is basically just the cost of litigation and the settlements that have been awarded. So those two factors are really what's contributing to push pricing up. And so we've got to be, creative's probably the word most readily used, but I think we've got to be sophisticated is maybe a better word in our approach to trying to mitigate cost while at the same time, mitigate risk, right? Compress cost and mitigate risk. And so there are a number of structures we can deploy, and, just to hit at a high level, I think is most appropriate for this call, because it will really be dependent on the property itself. But, some, forms of structured self-insurance, whether it's a captive or large deductible or retention program. There's a shared limits program structure, which is basically like aggregating scale across multiple members to increase buying power. And then just looking at simple things like raising deductibles and modifying terms to address some of this cost. It's really a cost benefit analysis. So what I would say broadly speaking is there's no silver bullet. It's really important to understand the underlying structure of the company, their financial wherewithal and balance sheet, and ultimately their risk tolerance to try and identify what's the most appropriate, construct for them. And that's where getting a quote just isn't sufficient. It's like you need some analysis, and ultimately our goal is to provide that analysis to our clients and to our prospects and give them optionality as to what the best approach might be.
Thank you for that. And I think that highlights the point that if your advisors aren't asking you more detailed questions, you should be concerned that they might be missing something, because there is so much more to it. Andrew, can you talk to us about some of the endorsements or terms that are just easy wins for clients that if you don't work with a hotel or resort or hospitality specialist, they might not know to look for, and it could end up costing a lot of money depending on the claims you run into?
Yeah, and I hit on this a little bit earlier, and I'll use some real common examples because, I think without an advisor providing you insights into these things, you're certainly at risk. And I'm going to start on the liability side of things. Carbon monoxide. So carbon monoxide is a pollutant, and there's a relatively standard exclusion called the total pollution exclusion. Now, you can look in the paper, you can look at settlements. Carbon monoxide issues, clearly do happen, and they cause, significant illness, impairment, and death to guests. And so, there's an amendment to that endorsement that's either free or at very low cost that most people don't pursue if they don't know about it, right? So that's where you need a sophisticated advisor to make those adjustments. In contrast, or I guess maybe in parallel, but a different scenario would be as it pertains to assault and battery. As we've seen the market harden, it's not only pricing, but it's restriction in terms, right? So the insurance carriers are, believe it or not, for-profit enterprises. And so they are charging additional premiums in some cases, but they're also restricting, what claims will be covered in the event that something happens. And so assault and battery is one that has been a provision that's we're seeing more readily, in which, if there's some sort of assault on a guest or third party, the coverage might not respond. And sometimes it's an expensive coverage to provide. I think it's really important for our hotelier clients to understand that risk and the cost to insure that risk and their level of comfort, depending on the class of property and geographic location, so on and so forth. So those are a couple of easy ones that we are seeing more readily in the market. But there's thousands, candidly, of endorsements and modifications to those endorsements that need to be reviewed by someone, not only an insurance professional, but someone who understands that industry really well.
Mm-hmm. Yeah, and the list goes on with innkeepers endorsements and pollution carvebacks for pool fumes. We could have entire podcasts just about that, and we probably will in the future. I want to kick things back over to John before we run out of time. So, John, if you want to wrap into some of your answers, just rapid fire, a few different questions here. Talk to us about the role that benefits can have in helping with the staffing issues and retention issues that everyone is seeing right now, and how a broker can help hotels play a part in that. And then if you also want to talk about like the rise of these association health plans and what you're seeing there and why, and some of the benefits of why it may or may not make sense for a hotel to participate in those plans.
Sure. So benefits, part of the overall employee package, pay package. And so, we all go to work really for one thing. Hopefully we enjoy it along the way, but we go there for financial security. So we get a paycheck, we get money, right? But we also need financial security against things like a health problem that we might have. So we get insurance from our employer. That's the way we do it in the US. But there's other pieces there that we can help fill in too. There's all kinds of additional benefits. And so then it starts to get a little bit muddy. So we have, health insurance and dental and vision and life and disability and law and, voluntary work benefits. And so I think what a lot of employers miss is the real easy to understand, concise communication of that benefits package. Here's why we've built this for you and what it does for you. And, on the property and casualty side, Andrew talks a lot about how a policy will respond. And it's the same thing on the benefit side. When I go to the pharmacy, what should I expect to pay? And it's that type of communication is critically important. And I think that a lot of advisors who do that communication, they put together packages of information that nobody ever reads. I mean, I probably would be guilty of not reading it either, but you'll see a benefit guide that is dozens of pages long.
Yeah.
And we need to break it down into, when you go to the hospital, here's what you should expect to pay. When you go to the dentist, here's what you should expect to pay. So I think a lot of it is a communication thing. I mean, employers spend millions and millions on these benefits, and they just don't get that bang for their buck.
Yeah. No, that's a really great point. So go ahead.
Yeah. And if I could just touch on a couple of other things real quick here. Yeah, so as I get into talking about association plans and how we've seen those respond, in particular in this industry, we're going to see higher costs coming this year. And on the health insurance side of things, we call inflation trend. And so that trend number is being ratcheted up by carriers right now. And there's a few things that none of us will read about, but we know about, that are causing this. And some of it ties back to the pandemic. So provider networks, think, a network of hospitals and doctors, they negotiate a contract with a carrier that's usually about 3 years in length. And so we're coming to the end of those contracts that were negotiated pre-pandemic or right at the beginning of the pandemic. And so now they're finally, for the first time, able to renegotiate with post-pandemic staffing issues. And so we saw people just leave the industry, and there's nursing shortages, there's doctor shortages. And what they're having to do is pay more for their staff. So when they negotiate with a carrier, they're going to say, we used to give you a discount of X. Well, now it's Y, it's a different number. They need to keep more money because their costs are higher. So we're seeing that starting to play out now. And those negotiations are quite contentious. So.
Well, you started to answer my next question before I even asked it. I was going to say, Nostradamus, tell us what is around the corner in the next 6 to 12 plus months. And most interestingly, give us the goods on what our hotels probably aren't going to hear anywhere else.
Right. So that's a piece of it. The other pieces that are driving costs, we're seeing come to the market now for the first time what we call gene therapy drugs. These are really expensive drugs. Think $2 million, but they're a cure. So the one that just came to the market it's a cure for hemophilia, and so it's a $2 million cost. And if that hits your plan, you're stuck. And so some carriers were very had some good insight into what was coming, and so they built up a war chest, if you will. They've been charging for years now, like 99 cents per employee per month. And it's just, it's just another number that goes in there, but they've been setting that money aside. And so if you're with a carrier that had that foresight, that $2 million claim doesn't hit your plan. In fact, it goes over there, and a $600,000 hemophilia claim actually is cured now. So that exits your plan. And so we're seeing that, that sort of lift in expense as well. I think, the other one that we're seeing is a huge pressure on drug manufacturers to drive down other costs as those costs are going up. It was just reported earlier last week, I think it was, the 3 largest manufacturers of insulin are dropping their costs by 70 to 80% as this year plays out. And so that's helpful, right? But it's all of these things that we have to take into account. We have to know. Andrew mentioned it, a very sophisticated approach to, you know, the upcoming renewal cycle, which most plans renew sometime in the 4th quarter. So we need to look at all of those, you know, little pieces that are going to be impacting that real big number, which can be, like I said earlier, millions of dollars.
Yeah, absolutely. Well, I mean, this is a whole nother topic of conversation, but science is just so amazing with some of these cures that are coming out, and it's a beautiful thing to see, especially when, you know, we hear from certain carriers that people who need insurance, they have to continue to have it. You know, these chronic diseases will bankrupt a plan. And so while these gene therapies might be more expensive upfront, overall, it's going to be less cost for the insurance company, which will mean less cost for you as a business. John, I know that you are the king of analytics as well. Talk to me a little bit about how you aggregate some of this data to help pinpoint for our clients exactly what they can expect for and need to budget for in the way of premium increases and other insights.
Yeah, so our practice is unique in that we're a true national practice. So we get to review information that comes out of California, Florida, Illinois. It doesn't matter. We're in every state. Most advisors work right in their city. So if they're in Dallas, that's where most of their business is. We get to see some stuff that comes out of other places. And so as we start seeing these trends, they generally show up market after market after market, but not all at one time. And so it can be a surprise to some. And so we obviously want to, you know, mitigate any surprises, make sure that everything is running on time and we know what's coming. You know, I guess I would say aggregating data. You know, I look at claim reports literally every day, and I'm just looking for what's the trend I see. Let's say 2 years ago, we all of a sudden saw, because companies that were making decisions, they were coming out of pandemic pricing. Actuaries at carriers were scared, and so when they get scared, they get conservative, higher prices. And so groups went self-funded, groups that had never been self-funded before. And that caused a cash flow shortage at the carriers. So all of a sudden these carriers reacted with, we need fully insured business. So we collect a full premium, not just an admin fee. And that money sits in their coffers for a while. They call it the float. They make money on your money as they hold it. And then they ultimately pay out a claim. And so they got super aggressive with trying to acquire or write more business that was fully insured. And so we saw large groups that have always been self-funded all of a sudden say, wait a minute, that's a great guaranteed offer, and I have to take that. So it's the advisor's role to see, you know, what is the inefficiency in the market? What's next? What's coming this fall? And once you can identify that inefficiency, you know, it might show up first in California, it might show up in New York. Once we identify that inefficiency, we can really exploit that, you know, for the employers out there that are saying, I don't know what to do, but we can help them with that.
That is that. Thanks for that, John. That is such a good segue into the last question before we go to audience questions. Andrew, I have had someone who's on this call right now ask me about, speaking of market inefficiencies, why can you sometimes get a one-off quote from State Farm that's 30 or 40K lower than everyone else? And where do those flukes come from?
Yeah,
and how do we find
market inefficiency? Yeah, I mean, I think it just comes from market inefficiency. You know, in the reality of the underwriting community, you know, different carriers are going to have different appetites. And so that's just something that we look at broadly when we're doing an assessment of a portfolio of hotel properties in this case, which is, you know, a property being very simple in South Florida on the beach is going to be a very different risk than a property in North Dakota. And they both have risk characteristics. Obviously, you know, everyone would assume that Florida is going to be higher risk if it's in the beach and hurricane zone. And so, you know, if you package those two properties together, Do you get some subsidized pricing because of one over the other? Maybe, but it also limits the ability for carriers to participate who might be really aggressive in the Midwest or North Central states and don't want to touch Florida. So it's really, the advisor's responsibility to run that assessment and that analysis and put together the best program, and then just the design to address like the State Farm or the Farmers insurance kind of one-off scenario where those are direct writing insurance companies where they don't deploy through the independent agent channel. And so, here and there you can find an anomaly where you can get, a really aggressive price on a property that's going to be more aggressive than we can achieve in the independent market. Now, at the same time, they get into an asset class or a market as fast as they get out from time to time. So you just need to be cognizant of the risk associated with, that short-termism we might see sometimes in those scenarios. But yeah, there are some inefficiencies, no doubt, in the marketplace. And when we can, exploit them to the benefit of our client, great. But certainly need to be knowledgeable about that dynamic and consult accordingly.
Okay, perfect. And for these questions from the audience, any of you three, feel free to jump on in. So the first one was, I don't have any claims. My loss runs are clean. And yet I just experienced a 40% increase on the last renewal. Why is the market punishing me and my business when I'm a solid operator?
Yeah, that sounds like that might be for me, or could be for me. So I talked about the macro factors earlier across the industry and the underwriting losses the carriers have sustained. So we're just broadly seen that occur. No different than the interest rate environment increasing. Like it isn't what it was 2 years ago. Same with the hard market in insurance for the reasons I touched on earlier. Now, there are things that you can do to combat that price growth. And I'll use a very simple scenario. If you want to bet on yourself, you retain a low deductible. Let's use a single hotel asset. You retain a $10,000 deductible. You don't have claims. You don't think you're going to have claims. To reduce your premium, you could increase that deductible from $10,000 to $100,000. You have to be comfortable and have the balance sheet to support that risk appetite. But that's one way to manage cost very thoughtfully, assuming you've got the right risk tolerance and the right, balance sheet to be able to support if you do have a claim. So there's things to do to combat, that premium increase and theoretically bet on yourself and, ultimately take a little bit more risk for a little bit more reward.
Okay. Yeah, I know you kind of answered that one earlier, but I wanted to say that one out loud because I feel like so many hotels I get asked that all the time. I'm a solid operator. My loss runs are clean. Why do I have to pay more? And why can sometimes certain brokers get better prices than others? And of course, as we discussed on this call, it's so much more than just a quote and a price. It's about, structuring the program the right way with your risk tolerance and making sure the appropriate provisions are in place and endorsements. But, money is a big piece of it. Everyone has a balance sheet to worry about. So with that being said, we have an operator with 21 hotels in New Orleans, Houston, West Palm, Florida, Sarasota, Jacksonville. And they're wondering, and obviously Andrew, Dave, I don't know if you're Nostradamus like John is, but they're wondering what types of increase on the property side they can expect. Obviously, we don't have a magnifying glass into the future, but I mean, what kind of advice based on what we've been seeing can we give this operator?
Yeah, it's really difficult. In those markets, it comes down to feet and miles with respect to exposure to the coast, to floodplains, to hurricane modeling, things of that nature. And the story is somewhat bleak. We've seen 100% plus increases. We've seen 400% or 500% increases in the marketplace. And what I think is the most important thing to do in that scenario is be very proactive, right? So, risk in Houston, albeit on the coast, is very different than a risk in Palm Beach based on hurricane modeling, et cetera. So, historically, pricing was compressed if you aggregated all of those 20 plus assets into one buying pool or program. In the given market environment, it might make sense, if that's currently the case, to deconstruct that program and have the individual assets buy their own insurance, and a combination of both. And so that's something that I think, and it would encourage this individual to be really aggressive and proactive about, is to hire a broker that knows what to do and how to do it in that regard, because it's going to be difficult. There's no doubt about it.
Thank you. Yeah, I think that's a great point, because the last few years, everyone talks about master program, economies of scale, but it sounds like in this market, that's not always the best route to go. Sometimes you want to deconstruct it. Dave, with your clients and insurance getting so expensive, I mean, are you running into talk to me about you running into hotels that are just going the bare minimum on insurance. Of course, you don't want to be overinsured. And, I know for us, Andrew, like, we'll flag if we see duplicative coverages within a program, but you don't want to be underinsured either. So Dave, talk to me about some of the, like, how often are you seeing that? What are some of the issues that can cause, and why that needs to be, like, really considered carefully?
Yeah, sure. I don't see too many of my clients really skimping on insurance, but I will tell you that, like everything in our lives, the desire is there to save money and to stretch your dollar a little bit further. And of course, there's always that inkling of, well, maybe I just cut back a little bit on insurance, or I'll accept higher deductibles or things of that nature. And again, where they really run into trouble, not only with their business objectives and their obligations, fiduciary obligations to their investors and their guests and otherwise, is in those contract provisions that are mandated by their mortgage lender or their franchisor to maintain those minimum coverages. And really, I think that from a practical perspective, that when I hear a client talk about wanting to raise deductibles, my practical question is, well, I don't think you want a deductible so low that you wouldn't make a claim for that amount, but you certainly don't want it higher than you've got availability of cash to pay the thing, right? And so those things really require careful consideration. And Andrew has done a tremendous job of explaining those things today. And I again, will just reiterate the importance of consulting with your advisors on those decisions when they're made, working with your advisors when your applications for renewal come due, to make sure you're filling those applications out properly and understanding what coverages you're asking for.
Thanks, Dave. And last one, and feel free to all three jump in on this. We have a gentleman down in Oklahoma asking, why does my broker always wait to the last minute to give me a quote? Are they doing that on purpose, or is there any way they should get it in sooner? I think he's basically wondering, are they lazy and I should fire them, or is that actually a thing?
Oh, man.
Can they control it?
Listen, I think that that it's all of the above. The market is definitely more difficult now. So it's kind of a systematic issue where, because the market's difficult, every broker, every agent, if they're doing their job, are talking to every single insurance carrier. 5 or 6 or 7 years ago, some of you guys might remember this, you get an early renewal offer, it's flat or it's a decrease, it's manageable within your expense structure. People would take those early renewal offers and move on. In today's environment, that's not even close to the case, where everything has to be marketed all the time. So it very much, to get on the top of that underwriter's stack, as far as something they'll look at, you have to have a very clean, very thoughtful submission for what you're asking for, to make sure that it gets on the top of the stack and is getting looked at, 60, 90 days out, to provide you with adequate time to then present to the client, make adjustments, negotiate final terms, and finalize. So there's in this hard market, it's even more important to have that really tight submission from, ourselves to the underwriters, so that they can make a quick and easy decision if it's a good risk, and if they have viability to win that prospect as a client. And so if you get a bare bones submission from an underwriting perspective, they're going to kick it to the bottom of the stack, and then it's incumbent on your agent to be even more persistent than they might have to be to get the quote out. And so likely what's happening there is that there's not a great submission, not timely put out. They might be holding it back just because they know the terms aren't going to be great, don't want to allow you adequate time to go get alternatives. So it might be a defense mechanism as well. But yeah, I think a week before is generally like unacceptable, even given the facts I just stated.
That's good perspective to have, because I think we all want to be reasonable. And so understanding what's reasonable is key there. John, can you talk about that a little bit from the benefits side? Because I know that, I came from the HR side in a previous life, and Q4 and benefits renewal time, HR has their hair on fire. And God forbid, you hear those horror stories, and I've seen it many a time. We're doing open enrollment on basically Christmas Eve. Why does that happen, and how can it be prevented?
Yeah, Andrew hit on it. I don't know that it's necessarily the answer isn't he's lazy, fire him. I think he's afraid. Whatever that broker is, they have some fear in them that whatever I'm about to deliver is not going to go over well. And so they rather than address the problem, they hide the problem as long as they can. But I think one of the most important things we talk to all the time with our account managers, account executives who really run that open enrollment process as far as the timeline, it's critically important that those trains run on time. There should be no surprises. There should be no hair on fire. We should be able to have enough time to make solid decisions, build a good open enrollment strategy, and educate your people. But you're right, Becca, we see it all the time where it's we made a decision far too late in the process. We now are doing open enrollment in December instead of November. And come January, all of a sudden we don't have ID cards. We have coverage, but we have a hard time getting care just because it didn't happen on time. And so I would, go ahead.
In a follow-up podcast, we'll have to talk to you about the approach that needs to be taken all throughout the year to get ahead of this before Q4.
Yep.
Dave, please bring us home from the legal side on what are we missing here? What do you have to add to that? And, obviously you're a cum laude from JD, so let us know, advise us here.
Man, we're down to, I think, 1 minute, and there's many more things we could discuss here. And so I think we've done a tremendous job, hitting all the bases and making all the turns. I've really enjoyed this time together with you all, and I appreciate you having me aboard, and I look forward to another opportunity to talk more broadly and maybe bring some other legal industry professionals along with me to address some of the topics that we touched on here today.
Absolutely. Well, there's a lot of Easter eggs for sure, appropriate pun given the time of year, but basically things that we could talk about further. Thank you so much, Dave, John, Andrew, for your time. This has been wonderful. We will put out the recording on LinkedIn, email a copy to everyone who hopped on today. So looking forward to next time. Hope everyone has a great rest of their afternoon.